Jose, mute yourself. All right. Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Hope everybody had a great weekend, great holiday weekend, and is ready to get back into it here. We're just waiting a couple minutes here to go live on all the different platforms. Go ahead and drop a comment there in the chat. As you tune in, we got the chat up on the screen. Feel free to drop a comment there. And we'll get started here in just a moment. Great topic here for tonight to go over. And it looks like we're live on all the platforms, so we'll go ahead and get started. So what we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping your comments there in the chat. And then you can feel free to drop any questions you have in the chat as well. And we'll answer them after we go through the presentation. We will get into the questions. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is our loan officer training, where we go over a new training topic. And tonight is something we're very familiar with here because we specialize in non-QM loans, which is the profit and loss loan. So I will go ahead and turn it over to Jose. I know he has a presentation ready, so let's go ahead and get into it.
Good evening, everybody. Thank you for joining us for tonight's training on how to structure a profit and loss loan. This is one of my favorite ones because this is really one of the ones that makes the investors' heads spin, right? Because it's a pretty easy loan, long as you have an accountant that can provide the necessary documents. And now in some cases, we have options for self-prepared P&Ls, but they still need some kind of third-party verification from the tax preparer. Now, keep in mind, when in this presentation, if you see the word CPA anywhere, that can be interchanged by accountant or tax preparer, because for this loan product, it can usually be any of the three, unless the guidelines specifically stipulate that it needs to be a CPA, and that they're not just using the word CPA instead of saying tax preparer or accountant. Now, as you would figure, this program is for self-employed borrowers only. However, we do have options like we do with all of our non-QM options that can combine the income types. So you can have a borrower qualifying under a profit and loss program that can also add W-2, bank statement loan, or asset utilization, for example, as may be applicable. So if they're self-employed, but they also have a W-2 job, they can qualify using both incomes as long as they are separate incomes. So what do we mean by a profit and loss loan? Well, a profit and loss loan is a loan that uses an unaudited, and notice I have that in bold type, unaudited profit and loss report to qualify the borrower. This is very important because it does not have to be an audited report, which is about the same as an income tax return. It is an unaudited report, which is basically an income and expense compilation. Now, depending on the guidelines that you're reviewing for the option chosen, as previously stated, the P&L can be prepared by a licensed CPA, an accountant, or an active status enrolled tax agent that has a PTIN, right? That's their tax preparer identification number. Again, be sure to confirm if the option you have selected actually requires a report to be completed by a CPA. And if it is a self-prepared report by the borrower, assuming that the guidelines that you are reviewing for that option do allow that, it will need to be accompanied by a third-party verification letter from the tax preparer. Usually it's more of a business narrative and states that the accountant has prepared the tax returns for the previous 2 years or whatever may be the case, 1 year, if it's a 1 year option for the borrower. Now, keep in mind, most options do require anywhere from 2 to 3 months business bank statements to verify the business activity, right? The income, gross income, and the expenses. Now, there are options that do not require bank statements. Most do. So please do make sure that you review the guidelines to ensure what is required regarding the bank statements. Because if the reason you're using P&L is because a borrower has a lot of overdrafts and now they require you to provide the last 2 months bank statements and they have overdrafts, your deal is going to be in jeopardy. Now, what are some of the eligible borrowers and transaction types? Well, like stated, this program is for self-employed borrowers only. Most guidelines require the borrower to own at least 25% of the business. That seems to be the threshold in most instances to confirm that you are an actual business owner. Usually owning less than 25% of the business will not consider you a business owner, or at least self-employed in that manner. Again, remember that all program options in non-QM have their own guidelines that are going to be specific to that investor. By investor, I'm speaking about the company buying the loans, not your investor who you're making a loan to. So our eligible borrowers here would be U.S. citizens, permanent resident aliens, non-permanent resident aliens, obviously with U.S. credit, and if they're a non-permanent resident alien, they're also going to have a work authorization as well for this program. First-time home buyers are okay. However, real important to note, this program is not possible for foreign nationals because due to the nature of this program, they have to have U.S.-based employment, right? They have to have their business, which is generating income for them. So a P&L program would not be possible. The only scenario where you could have sort of a foreign national qualifying for this is if, for example, they have the E2 visa, which is a visa usually grants them 5 years here in the U.S. It's a business owner visa. Basically, you invest in a business and they give you the E2 visa, which gives you the right to operate your business, and they give you a tax ID number also. They'll even give you a social security number with it, which, as long as you have the E2 visa, is valid, and then you can apply for U.S.-based credit, right? So that would be there, a non-permanent resident alien that's no longer a foreign national, right? They have the E2 visa, which gives them status. But if they're a true foreign national, they're not going to have the U.S.-based business here. So there's no way that they would have a profit and loss that would be acceptable from their country. It is possible for primary second home investments, first mortgage, and we actually do have second mortgage HELOAN options. That's our fixed rate, fully amortizing second mortgage, and those are offered with a profit and loss option for the income type, just like we have DSCR, and we also have bank statement and full doc for the HELOANs. Max is 90% LTV for an owner-occupied purchase, 85% LTV for an investment purchase. Now, what are some of the issues where a profit and loss loan can assist? What are they a workaround for? Well, the first one is pretty obvious. It's a good option where tax returns do not fully capture the cash flow for the business, right? You know how that goes, too many write-offs. Now, normally for this type of a scenario, the first option people immediately think about is a bank statement loan, which is a good option. And remember, 1099 could be an option also if they receive 1099s. If they don't receive 1099s, then the bank statement option is usually going to be better than the P&L option. simply because there's more liquidity in secondary regarding bank statement loans, which means you're probably going to have more investors offering it, and you're going to have more competition, which means you're going to have lower rates and or less expensive cost to the rate, right? Maybe even higher LTVs. So if, however, the P&L is the perfect solution for a bank statement loan gone sour because of, for example, declining deposit trends, too many NSFs, too many overdrafts, unverifiable large deposits, or declining or low ending balance. By the way, this is usually the reason why you would only look back 12 months on a bank statement loan versus 24 months, even though 24 months will give you usually a little bit lower cost to the loan, to the interest rate, but you're exposing, when you have that 24-month look back period instead of 12, you're exposing yourself to some of these issues like the declining trends, right? If in the previous 12 months the deposits were higher than in the current 12 months, you have an issue. So when you are analyzing those, please keep an eye out on using 12 months instead of 24, or using the P&L as an option if it's just not going to pass any of these tests, right? Declining deposits, NSS, overdrafts, unverifiable large deposits, or declining or low ending balances. So let's talk a little bit now about the actual income calculating. Although, frankly, there is no real income calculation that you're going to do per se. You're going to look at the profit and loss report that's prepared and provided to you, which is going to have gross revenue or the gross income, is going to have the expenses, and then it's going to have the net income. And that net income divided by however many months have elapsed, or if it's a 12-month report, because it all depends if you got a year-to-date report plus a previous 12 months, or if you're just going straight 12 months from today going back, right? So you're just going to look at the net income, and that's going to be the income, and then you divide by 12, and that's going to be your monthly income. Make sure you review the report and that it is correct before turning it in. There may be some mistakes, there may be some typos, the income may not add up, in which case you may want to reach back out to the borrower and have them contact their accountant and make sure that they got it right and they didn't click on the wrong the wrong button and give you the wrong amount, right? But what are some of the points to consider when reviewing the P&L report, or when even asking for the P&L report? The first is the most important one. The business needs to have existed for at least 2 years. That's 24 months. But there are options for 12 to less than 24 months if, number one, the borrower's previous employment is verified to be in a field that provides the same products or services. For example, you were working as a licensed electrician for a company, and now you're a licensed electrician on your own. Or you were a doctor, which is also another licensed job for a hospital, and now you're a doctor receiving a 1099, for example, from that hospital. I mean, you'd probably do a 1099 loan there, possibly, but P&L is still an option. Or any other type of job where you're doing similar duties as a W-2 employee, and now you're doing it self-employed, right? Similar responsibilities as in the current business. Now, keep in mind, and again, this is where you have to read the guidelines and review. Keep in mind that some options allow combining profit and loss reports from 2 separate companies. Keep in mind, these companies have to exist for the amount of time needed. Now, however, I actually had the situation where they had one company, Company A, but then they moved from New York to Florida and they had to start another company in Florida. They had to do an LLC for Florida when they wanted to, for whatever reason, they needed to do it. So now, in essence, we have one company that was, I think it was like 13 or 14 months existence. And then we have the new company that I think was like 10 or 11 months existence. Between the two companies, we have the 24 months. They were the same type of business, an automobile dealership, online type brokerage, right? Auto broker. But due to the fact that it was the same business, it was even the same name. They just changed like the end of the name, but it was even the same name. So that one was pretty easy. We were able to show between the two separate operating agreements that the two entities were actually the same business. Just one stopped operating in New York, and the other one had started operating in Florida. So no problem there for the two P&Ls from the separate companies, but you can actually have them from companies that are running concurrently, right? They've all both been around 2 years or more. However, you need the income from both to qualify because of the structure the borrower has for their businesses. That would be totally fine. Now, keep in mind that the expenses that are on the profit and loss report need to make sense for the type of business, right? Underwriters know business is how they operate. If it's a service related business, they're going to look at it one way. But if it's a products related business, like for example, a retail store, a convenience store, they know there's a lot more overhead and a lot more expenses for that type of business. And if you're running a business out of your house, online type business where you have very, very little overhead, no employees, it's just you. So, you're probably going to have some variable expenses there, but hardly no fixed expenses. So they do look at that, and it has to make sense. Uh, the P&L needs to cover the last 12 months, most recent consecutive calendar months, or last 12 months fiscal year plus a year to date to confirm no decrease. So again, you would probably want to look at the guidelines for the option that you're choosing to see if they require the last complete 12 months fiscal year plus then the year to date, or if they can let you go from today 12 months back and just do it that way. Capture a month to month activity rather than the fiscal year plus year to date. That's really important to know because you don't want to ask for the wrong report, then find out after the file comes back from underwriting that the report you turned in was useless because it only provided half of the information. Now, for options requiring professionally prepared reports, right, you have to be aware of that. Be aware that the CPA, tax preparer, or the enrolled agent needs to certify that, in the letter, they have to write that they have prepared the borrower's most recent tax return. If you're using a 1-year P&L, the borrower's most recent 22 and 23 tax returns if you're using the 2-year P&L. Keep in mind also that the CPA or tax preparer needs to prepare a letter on letterhead to actually provide the P&L. One thing is the cover letter that they're going to provide, which is going to be like a business narrative, and the other one is actually the P&L under letterhead for either the 12 or 24 months period that you're looking for. And now, last but not least, I wanted to go over, this is a sample guideline here, just so that you can understand how they are all different. Now, this happens to be a sample guideline from one of our investors, but you will see how it's pretty cut and dry, how they stipulate here that it has to be from a licensed CPA, CTEC registered tax preparer, or IRS enrolled tax agent. The licensed CPA will have a license, and the other two will have some type of PTIN number, some type of registration number that you can usually verify from a portal. Like IRS, for example, has a portal that you can verify all of the IRS enrolled tax agents. It's pretty easy. Just go to the portal, enter their information, it comes up, take a screenshot of it, and you've met the requirement for verifying the PTIN for the tax preparer. Notice how this one states that the PO needs to be strictly the 12 months most recent calendar months, or all separated out by years and year to date. It's one or the other, right? You're either going to give them 12 months out, or you're going to give them the last full year plus current year to date, right? So, I mean, I don't know what would be the reason why you would want to give a full fiscal year plus current year to date. But if there's any financial reason when reviewing the reports, maybe that's the reason why. Otherwise, you're just complicating yourself. Now, notice here how they give you a couple of different portals where you can verify the CTEC registered tax preparer, the CPAA license, the IRS PTIN for the tax preparer. Those are all pretty cool links. I suggest you use them. And then notice the additional details that they provide there. When it tells you strictly here, they say with a combined loan to value greater than 65%, they need 2 months of consecutive personal or business bank statements. The most recent statement dated within 120 days of the note date. That's the date of closing. And notice it says they're also very important. Total deposits reflected on the bank statement minus any inconsistent deposits or deposits unrelated to business activity must support at least 75% of the gross income reflected on the P&L. They're giving you a 25% margin there of deviation. And the P&L period must be consistent with the bank statement periods. If bank statements do not support the income reported on the P&L statement, the underwriter has the right to request additional months of bank statements to verify the income on the P&L. This is acceptable in cases the nature of the business implies such a situation. No more than 3 NSFs allowed. So you got to read into the guidelines and make sure that you don't get caught off guard. And that last bullet point covers the 24 months, or in scenarios where they'll accept less than 24 months. I think I already covered that in the bullet points. I just wanted to show you how it looks in the guidelines. So again, you get used to the habit of reviewing the guidelines and realizing that these guidelines are specific to the investor. Just earlier today, I had an MLO come into the Zoom room asking me about first-time investors and DSCR loans, and asking it in a general question, like, as if it was applicable for all DSCR loans. And I had to remind her again that non-QM loans, the guidelines are specific to each investor. So she would have to see which are the options under consideration, access the guidelines and the matrices for those options, read them, and see which is the one that is most favorable to the borrower. Right? Very important, because not any two guidelines are the same for non-QM.
All right. Thank you, Jose. I don't see any questions, so I think we can go ahead and wrap it up. Remember that we do this every Tuesday, Wednesday, Thursday evening at 7 p.m. Eastern, where we go through a new loan officer training. So we will see you all tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage